higher than where we'd want it to be if we wanted to be in a decreasing rate environment. A lot of that money that's not being spent on real estate right now is going into equities, and not just Canadian equities, not just the Canadian stock market, but the US stock market. The rich are getting richer in Canada and the poor are getting poorer. Be careful what you wish for, I would say, with that one. But this will take decades, right? Like this will be a 10-year trend at a minimum. The severity of price decreases is worse the further you get from the core. Canadians individually need to be able to spend more money if our economy is going to grow. And you cannot do that a long period of time. I would expect that to continue. Even when we get to recovery, it will be a very slow recovery. This is a good outcome. As real estate professionals, we want this to be taking place. And so this is a trend that I think is really important for people to look at. And if you have first-time home buyers, I would be strongly encouraging them to at least start the process of looking. This is like the clearest image illustration of how we're progressing towards a renter's economy. Hey, everyone. I guess everybody's kind of still just filtering in, but just gonna get my screen shared here. There we go. Okay, so I'm going to do a quick, well, I always say quick, but it never ends up actually being quick. But I'm going to do a quick run through kind of all the factors that are impacting our housing market right now. I'm going to start with the debt market. As we know, the Bank of Canada has an announcement tomorrow. I'll cover what we're going to be talking about there, or sorry, what we can expect from them there. And then I'll also cover the housing market nationally and locally. So I'll do a little bit on Canada. Kind of, I think that the big thing is, the market's kind of cut into two right now. Very distinct differences between affordable versus unaffordable markets. So we'll get into that. And then I'm going to, unfortunately, beat the dead horse of recession and trade war. Recession being kind of a little bit of a question mark, but the trade war being certainly evident. It keeps kind of resurfacing. It's like, is this just going to keep going on with 90-day pauses forever? But we're starting to see some consequences of it be observable in Canada's economy. So as always, my preference is to do this more as a conversation than a presentation. So Courtney or anybody, if you want to interrupt me throughout, feel free. If I'm not making something clear, if you want me to kind of double click on something, I'm always happy to do that. Okay, so let's get into it. First things first, tomorrow's announcement, the expectation is that the Bank of Canada will hold rates. I would agree with that. And your Canada 5-year government bond yield kind of higher than where we'd want it to be if we wanted to be in a decreasing rate environment. And the bond yield is sort of a decent forecasting measure for what the bond market or like the market is expecting long-term rates to be in Canada, given that this is a 5-year outlook on rates, because they're buying a government bond for a 5-year period. Fixed rates are based on government bonds because if I'm RBC, I can either buy government bonds and therefore in doing that, I'm lending money to the government of Canada and I'm getting a 3% rate, or I could lend money to Courtney and my expectation would be that she's maybe slightly less creditworthy than the government of Canada. And so I would expect a little bit of a premium on that, usually 1 to 2% or 100 to 200 basis points. So this is where you'll often hear GOC plus 1 to 2, which is in your mortgage pricing. So fixed rates are often about 100 to 200 basis points higher than the government of Canada bond yield. And so this is where we've got our fixed rate environment kind of in the 4% range. Usually, again, we'll track your Canada 5-year bond yield with relative accuracy. The spread tends to increase in periods of risk and decrease in periods of less risk. Actually, I'm not even going to mention this so much, but this is just the Bank of Canada recently looked at international trading flows and who actually owns the majority of it. And the largest portion of Canadian government bonds are actually owned by non-residents, so foreign capital flows. And historically, it's been a lot lower. So we do have a high degree of vulnerability to the global economy on that rate environment as well. The interesting part about this whole thing is that the bond market is typically wrong. The market is almost always wrong about what central banks will do. So you can see historic. So it could be right now, and then it's sort of decided on its rate path. But then at some point in the future, something changes and the market ends up being wrong. And so you can see all of these lines here that show basically what the market thought rates were going to do, and then the red line is actually what rates ended up doing. The question that this chart ultimately, and this is from Deutsche Bank, by the way, the question this ultimately asks is why would the market be right about what the rate path is going to be today, right? In regards to the foreign capital flows, I found that one thing was interesting. This came from Better Dwelling, but they recently put something out basically that Canadians are spending less money on real estate, so we're buying less and less property. We know this as real estate professionals. The transaction volume has been significantly lower. Um, Yet Canadians are spending more money on US stocks. And I think that this is kind of like that shiny object syndrome a little bit, where the stock market is looking really sexy right now. You've got, great returns. Everyone's piling into it. Retail capital inflows are like the highest they've been in a long time. Um, and so I think that it's predictable that you would see a large flow of money. A lot of that money that's not being spent on real estate right now is going into equities, and not just Canadian equities, not just the Canadian stock market, but the US stock market. So just interesting thing to observe. A couple more things on debt trends. Statistics Canada put out a really interesting cross section on which age brackets are seeing the most debt, and it's your 35 to 44-year-olds are the most indebted Canadians based on debt to income ratio. This is from Statistics Canada. And the same cross section, they also analyzed wealth disparity, and Canada's income gap is actually the highest that it's ever been. So basically, the rich are getting richer in Canada and the poor are getting poorer. And a lot of this comes from wealth that's tied to real estate. As we know, Canadians hold the majority of their wealth in real estate. And so I always thought that this was an interesting thing to be observing about Canada's market. This also tends to play a big role in sort of what's happening between the rental market versus the ownership market, where your owners end up kind of amassing more wealth, but it ends up, if it gets more and more expensive or less and less affordable, if you have an affordability crisis or a housing crisis like we have in Canada, there's fewer and fewer transactions, right? Europe is a really good example of this. If you go to like Switzerland, Germany, the UK, et cetera, the number of transactions per capita is way lower than it would be in a place like Canada. And so Canada and the US buy and sell a lot of real estate because historically it's been relatively affordable by comparison to countries like those European nations. As we progress further and further into that realm of unaffordability, like Europe, we end up being at risk of reduced transaction volume. And so very much real estate professionals in kind of Canada's larger, more unaffordable markets, and I'm going to get to what markets we're still seeing volume, and what markets we're not. But in your unaffordable markets, so basically Vancouver, the lower mainland, let's call it, and the GTA or Greater Golden Horseshoe, um, those markets, real estate professionals are doing more and more leasing, less and less transactions. Could this spread as a phenomena coast to coast? Probably, and we'll dive into that a little bit. But basically, rental tenure is going to become more and more common, which means homeownership will become less and less common. And a lot of people are looking for a bull case for Canadian real estate, and I would say that this is it, right? Like, and it's not to say it's a good thing. This is a really bad outcome for a country, but the bull case for single family residential housing in Canada is that we're heading towards a renter's economy, and so home ownership will become scarce. It's not just the real estate asset that will become scarce, but the ability to own a home is going to become increasingly scarce over time in Canada. CMHC put out their delinquency rates for all credit products. Everything's increasing, but you can see mortgage and HELOCs at the bottom there. So your two real estate secured lending categories are basically flat. Everything else is trending up, and there's a handful of reasons why this could be the case. But basically, the big one is, you know, your house is typically the last mortgage you go delinquent on. So you go delinquent on, your car loan, your credit cards, your line of credits, and then, the house is like, the last thing you want to stop paying because you don't want to lose the house. The other piece is that our accountability environment has changed a little bit in Canada, where we have like this Canada Mortgage Charter, and basically banks have to do a lot of things to accommodate you if you're in a position where you're having a hard time paying a mortgage. And so I think that plays a big role. There's really no evidence that that's correct. It would be very hard to create evidence that that's correct, but it just feels like to me that if banks are more accommodating, that would mean that more people are getting accommodated, which would mean that you're seeing a lower delinquencies because the economic setup is one in such that we should see delinquencies be a lot higher than they are, and yet they're not. And so the question is why? And my answer would be probably that banks have more measures than they ever have to make it easy for people to not pay their loans, but like to help alleviate the pressure in people where people are in distress situations. Um, Interesting thing about the way the consumers are choosing their mortgages right now. Fixed rate mortgages are so your 5 year fixed is historically the most popular mortgage product. Right now, the least popular mortgage product. We saw that big spike in people taking kind of like your 3 year fixed, which is the red line here, and that's actually fallen off. So that people taking the 3 year fixed would have been people basically consuming or communicating to the market that they felt that rates would be lower in 3 years than they were when they were taking the mortgage, let's say a year or two ago. I guess a lot of this was last year. Now consumers are communicating that they think that um, your mortgage payments or sorry your interest rate will come down sooner than that, and they're doing that by taking a variable rate. So variable rate has actually usurped the 3 year fixed as the most popular mortgage type. So consumers are more and more taking variable mortgage rates to try and capture that downside potential in rates. It's interesting because most economists and the central bank are sort of signaling that they think that rates will be sort of where they are or kind of be in a higher for longer environment. I really think that the whole thing depends on the Fed and what happens in the U.S. And if they get some good inflation data and they start cutting, and we've talked about that. I've talked about that quite a few times. But I would say that like my thought is that rates will start coming down at some point in the future, but it doesn't seem like there's just no data to push a central bank to make that decision anytime soon. But I think that we will start getting more and more bad economic data, which will likely increase the likelihood that central banks will cut. Like I would say by the end of the year, it's likely we'll see at least one more cut into next year, I think. And so do I still think that we'll see another 100 basis points of cuts? Probably. Um, you know, be careful what you wish for, I would say, with that one, because the economic indicators that necessitate 100 basis points more of cuts is usually not a good economy. Um, all of this really leads me to kind of like this next research note that the Bank of Canada put out recently on their website. I would encourage you to just Google this title, and if you want to explore it, all the charts are interactive that I'm about to show you. So this is the Bank of Canada basically showing what the bond market and so your 5 year and 2 year government of Canada bonds, as well as the policy interest rate, believes the rate path is going to be like, and this would really allude to that sort of higher for longer situation. Um, Even with that outlook, they have about 1/3 of people renewing with an increase to their payment. So I know that there was a lot of headlines that came out like as many as 60% of people could see increases in their payments. But the likely outcome model by the Bank of Canada is that about 1/3 will see increases in their payments. So you've got two charts here. The one on the left is mortgages with payment increases, and it just basically lists the ones that have. So there's no variable rate on this because your variable rates they have already seen their payment increases. You've got your fixed payment variables. So when they're resetting into the new rate environment, they'll see, so it's a very small portion of the total mortgage basket, but they'll see their rates increase. And then you've got in the blue on the left-hand chart, you've got your fixed payment, fixed rate, 5 year fixed, small amount of those. And then that was your 3 year fixed, the blue, or 3 or 4, 2, 3 or 4. And then your yellow, which was all of your 5 year fixed people who took mortgages in like 21 are coming up for renewal, or sorry, 22 are coming up for renewal. Sorry, 21 is coming up for renewal in 26. 2020 is coming up for renewal in 25 on your 5 year fixed products. They will see an increase in mortgage rates because mortgage rates were super low in 2020 and 2021. On the right hand side, you see mortgages with payment decreases, and so we're at the point where about as many people will see decreases in payments or no change in payments as we'll see an increase. And a lot of that's your your shorter term fixed mortgages. So a lot of those 3-year fixed people where we saw that big hump and they made the right decision on the rate. I have one of those renewing in October. My rate will be probably 150 basis points lower than it was. I think I was at like a 5.4, uh, yeah, 5.4 3 years ago, halfway through 2022, I guess, or end of 2022, and so end of 2025, that'll come down. I'll probably renew that in the low fours. I'm hoping. The Then you have your fixed payment variable. There's a portion of them that had their rates set at a point where they'll actually see their rates come down on renewal, and then your entire variable rate people, because they already saw their rates increase, they're either heading into a variable rate environment where rates have come down, because again rates went up and now they've come down, or they're going to be renewing into a fixed where they can capture a lower rate. And so
Yeah, I'm just
yeah.
going to hop into some comments and questions here. We had somebody comment that mortgage holders are likely opting for variable because they think they may have to sell.
Could be another reason. I don't know if it's fair to cast that on the entire, like, mortgage holders is a lot of people, right? And so like to assume that all mortgage holders are all the fact that the majority of mortgage holders are variable, are taking the reason they're the mortgage for that reason, is probably a pretty big assumption to make, or pretty big generalization to make. Would it be likely that many people would be choosing variable for that reason? Because, and just to contextualize this, or clarify, typically your variables are open or have a smaller penalty than a fixed rate mortgage. And so it would give you a greater degree of liquidity or flexibility to sell a property. Definitely a reason why some people are choosing to go with the variable rate, but I don't think you can say the entire market for sure. I think, if the entire market was doing that, then we would see 30% of properties going up for sale in the next year, which would be a catastrophe. So
And I'm just going to ask a question that came in. How long do you think we have before the renter's economy comes to full fruition? How long do you think we have until homeownership is gone with the wind?
well, it'll never be gone with the wind per se. Like I just think that we'll get to a point where we'll look a lot like Europe. Like, so right now, Canada's home ownership rate is 66%. So two-thirds of Canadians own homes. Uh, I think that we'll get closer to, like, you look at like a Germany, the UK is lower than us, but they're like in the high 50s, I think, or low 60s. Germany would be like one of the lowest. Switzerland is also pretty low. I think it's pretty easy to see that from a policy perspective, Canada is heading in that direction. But if you go back and look at what happened in a lot of those economies, the infrastructure of switching from a ownership to rental economy it doesn't just happen overnight. You need to build a lot of rental housing, and that's what we're doing right now. And I'll cover that pretty exhaustively towards the end of this report. But this will take decades, right? Like, this will be a 10-year trend at a minimum, to get to like kind of 50 whatever percent. You can see slowly Canadian home ownership rate falling, right? Like, we came from 69% to 66%. Um, that'll continue to fall as we build more rental than ownership tenure, right? Like, that's just how it's gonna be, and you can see that happening now as a result of CMHC's MLI Select program, and basically favorable terms for investors to create housing, more favorable terms for investors to create housing than for ownership housing to be created. So I would say, like, probably like it'll never be gone with the wind. For us to get to a home ownership rate in the 50s, you're probably 15 years, to be honest. Yeah. Any other questions there before I move on?
Nope, not right now.
Okay. Um, yeah, so all of the things that I mentioned before there, to kind of summarize that, the Bank of Canada has basically these two charts. So by the end of 2025, they have 70% of people not seeing a change in payments. So when people say like the majority of mortgages will see higher rate, actually the majority won't see any change. You'll see about 10% see their payments decrease, and about 18%, just shy of 20%, let's say. So 20% increase, 10% decrease, and the remainder, no change in payment. By the end of 2026, and this is including both years, about that, the number of people who see their payment decrease jumps up to almost 25%. So almost a quarter of people will see their payments decrease. Uh, Less than half will see no change in payments, and then about a third will see an increase in payment. So that's where when we say about one third of all mortgage holders are likely to see payment increases by the end of 2026, this is the Bank of Canada data that's substantiating that.
Hey, just got a couple more comments and questions come in.
Sure.
Um, someone is wanting to confirm that what you said the ownership rate could drop to in the future. It was closer to 50% from the current two-thirds home ownership rate.
Yeah, I could see it getting into the 50% range. I don't think we'll get to 50%. Well, I mean, eventually probably we will, but like I would say in a 15-year outlook, we'll get into the 50% range. Like, so you'll go below, you'll get below that 60%. Like I think you go 66 over it. Cast that out. You drop like 1% per year for 10 years. It still takes us, 10 years to get to high 50s, right? 56% or whatever. And it's never like a straight line like that. Like it's always kind of up and down. If you go look at it on the past 20 years, like some years it's higher, some years it's lower, or whatever. But unless we see some change from a policy perspective, like the writing is on the wall. We're building way more rental now than we are homeownership. And even if you account for the condo boom, or the all the subdivisions that were being built, not the majority, but a lot of those end up as rental tenure as well. You see like a lot of investors buying up those condo units. That's how they get funded. Um, but yeah, so I don't say 50% per se, but into the 50% range. That could be, anywhere from, I think to me, as soon as like your homeownership rate starts with a five, once you're in that 50% range, that's really progressing towards a renter's economy. If you actually want to be completely in a renter's economy, you'd have to have more renters than owners. Do I see that? I see that happening in my lifetime? Yes. Do I see it happening in the predictable future? Probably not. That the if policy continues the way that it is, it could happen a lot faster. I think eventually you'll start seeing pushback. I think you'll see a lot of baby boomers start like in a 20-year period, a lot of baby boomers start selling houses, right? Now all of a sudden, or passing away or whatever it is. And now all of a sudden you get this redistribution of wealth. You get more wealth put into the hands of the younger people. The younger people have had more time to accumulate wealth. And so that can kind of push back against our progression towards a renter's economy.
Okay, now we
Uh,
just another question about the European market. Do people in those countries stay in a home longer before moving? Like Canadians are on average 11 years. Would Europeans be closer to 20 years?
yeah. So typically your European housing model, there's very little transaction. Like people don't really use homes as like climbing the housing ladder. And say European is a generalization because that like there's Western Europe and there's Eastern Europe. So when I'm talking about a European housing model, I'm really talking about more the Western European housing model. A lot of Eastern European models have they're like especially the post-Soviet states have the I guess socialist or communist influence or former communist states, and so a lot of them actually ended up handing assets to so they have really high homeownership rates, right? They have like some of the highest homeownership rates in the world in like Romania, right? Some of those areas. In Western Europe, it's a little bit different, where you start to see lower homeownership rates, and in those markets, homeownership is very much a multi-generational thing, right? Canada, the US, and Australia are really like a couple of the countries that still haven't really like adopted this thing, but multi-generational living is very common around the world. It's not to say whether or not I think it's the right way to do things, but everyone else has done it in some form. Um, and so in Europe, people in a lot of cases, like you'll speak to people and their families own the house for like 100 years, right? It's just been passed down generation to generation. And a lot of young people, when they go to like start their career and work and live in an urban area, they rent. And then when they move back out to the suburbs, they're kind of taking over the family home or whatever. And there's a lot of easier ways to sort of stratify houses. So like you could split up houses into multiple units. If you go look at like, go browse houses in like Italy or France, and it's not uncommon to see like you can just buy a unit within like a small house, right? But generally, yes, people own their houses longer in Western Europe than well, and in Eastern Europe as well, actually. But they own their houses longer. Like we just don't have this idea of like constantly trading up houses and almost like a housing Ponzi scheme or like this wealth creation ladder like we have in Canada. Um, any other questions?
Nope, can move on.
Okay. So TD did an analysis on this as well, um, with what's happening with rates and mortgage payments, and basically the conclusion that they came up with is that Canada's aggregate mortgage payments are trending lower. So if you add all of the mortgage payments of all of the Canadians together, it's they're trending down by comparison to what we expected. This mortgage renewal wall that we hear a lot about, that has sort of been softened. Before it was like you weren't going to be able to get through it. Now it's like we should be able to drive through it. You probably still, maybe your bumper will fall off, or you'll damage the front end of your car, but we can actually make it through. So it's going to suck, but it's going to suck a lot less than we originally anticipated. Um, the the next piece is they kind of tied this to that wealth disparity thing that we were seeing, where basically debt and leverage is the way they measure it here is your debt to disposable income ratio by income quintile. Your lowest income quintile is, so the poorest people are seeing the most household indebtedness. So again, the StatCan did it sort of by age. The TD did it here by um, income bracket. And so this all of this is really to say that we've seen a lot of wealth creation happen as a result of real estate, and there's a further and further encoded disparity that's happening between asset owners and non-asset owners, and this is all things that kind of lead me to believe that we will continue down the path of decreased ownership and really sort of a separation of classes between owners and non-owners, which is not a good political or policy outcome, by the way, but it is sort of the way that things are going. Um, Interestingly, if you look at the way that people are piling on debt right now, older people are actually increasing the amount of debt, or sorry, are seeing the largest percentage increase in indebtedness among anyone, and the people younger than 35 are actually seeing the only group of people that are actually seeing a decreasing amount of indebtedness. So and the biggest reason for that is because your line sort of starts in 2022. The biggest reason for that is we basically can't afford to buy houses anymore, so we stopped buying them, and so our mortgage indebtedness as a group of people under 35 just stopped growing at that point. But you started to see all the other groups of people increasing their average mortgage debt by age group. And so your 45 to 55, the red line here has been increasing. Your 35 to 45 has been increasing, but slower. And then basically 55 plus has actually been seeing the biggest increase and the fastest increase in the amount of debt that they're piling on. And a big reason for that is a lot of these people are actually co-signing on mortgages for their kids, right? Or taking out HELOCs to help fund mortgages for their kids. So that's interesting thing to observe is that homeownership is so out of reach that you need parental support or like multi-generational savings to achieve it. I
I had an interesting question come in about the rental market.
Yeah.
Somebody says, do rents go up if we enter into a rental economy, or will rents go down as lots of rental units are being built?
Um, so it's kind of a chicken and egg question. Right now we're seeing rents falling. And so if rents are falling, like it's really just basic economics. If things get cheaper, people are more likely to consume it. So if rents fall, that'll actually expedite the rate at which we progress towards more people renting than owning, because renting becomes more financially feasible than owning. And so if rents come down, we will see, provided that again, like, the easy way to answer the question is it really depends on supply and demand. But if we are progressing towards a renter's economy, if we still have policy designed to make it easy for builders to build rental, then rents will probably not climb per se, because we're building enough rental to make it affordable for people to move towards that rental model. Eventually, when we stop building that, or if rents stop growing, which they have, and you're already actually seeing this. Mike Moffat just put out a chart on it, but basically that CMHC actually modeled out into 2027 that they expect housing starts to decrease pretty substantially. Housing starts just hit a record or sorry, they're up like 14% year over year for June. And so we're seeing a lot of stuff under construction right now. But builders are modeling forward and saying, if rents keep falling, or if I'm assuming rents are going to fall another 10% by this time next year, why would I build this thing? I'd just rather wait, right? And so you get your supply, prices come down, prices are down, so nobody wants to hit supply, and it kind of just it oscillates, right? So I would say that if we progress towards a renter's economy, it typically means, and if you look at sort of what's happening in a lot of these European countries, it's not nearly as expensive as a percentage of household income to rent a property in most of these countries as it is in Canada. And so, if we are going to progress towards that, we need renting to be cheaper, and it needs to be more financially sensible for people to rent and then save their money um, than it is for them to own a home. Because a lot of people are making that decision. Do I want to pay the extra? Because it does cost more on a monthly basis to own a house. Do I want to pay the extra and have that going into principal and saving my money for me and investing in that hard asset? Or am I good enough at saving and investing on my own that I want to make the decision to rent? And not everybody gets that decision because some people do it out of necessity. But um, when you're boiling down the comparison of incentives, that's the way to think about it. I saw a follow up there, tapping into the same questions with all big banks, changing policy from 4 days a week from the office starting in fall. Is there any chart? What does that mean in terms of demand for major cities, downtown Toronto specifically? Um, can Valerie generate that maybe? So there is a good chart I mean, like we've been seeing a clear reurbanization of demand for a while now, even before return to office was mandated to the level that you're describing. Um, for like if you just look at the most recent Treb Market Watch reports, you can see urban areas are doing a lot better. So prices have been a lot more sticky. They're not they're down still, but 905 as an example is down way further than the 416. And so you're seeing more demand propping up prices in your 416 than the 905. And a lot of this could be the urbanization that we're seeing. You got fourplex policy, sixplex policy happening in the 416 area that could play a role, but the bigger piece is probably that your end users are actually starting to, the dream that we could all live in cottages. You go look at the 705, right? Kawarthas, Muskoka, the prices are way down there. And so um, the severity of price decreases is worse the further you get from the core, because that idea that we could all work remotely and live far away from the city and take a train in once a week or whatever appears to be diminishing pretty quickly. And so we are seeing a reurbanization of demand. I don't know how else you would chart it. Like I guess I could probably chart prices in like Muskoka, Kawarthas, or even just 905, 416, and it would probably illustrate that reality. So yeah, I would say like core has definitely been stronger. You see this across the country, except for Ottawa, because their return to work hasn't really been as mandated, although it's kind of starting. But government workers have, I think their return to office was 3 days a week, whereas we're seeing like banks and telcos and companies that are headquartered in Toronto going to 4 and even 5. Another one, Ryan Dehaney, are REITs, pension funds, investors moving out of Canada. Could this create a monopoly in the multifamily space? Unlikely. I think our rental ownership model is already so vast that there's enough capital. And like even if you look at CMHC, MLI Select, I mean, there's tons and tons of small projects being funded, and like a lot of people can only get a hand, one of those or two of those, right? And so they're doing them, but that creates hundreds if not thousands of owners. Will we see an oligopoly? Yeah, maybe, like where we have a handful. We already kind of have that. You have a handful of very large Canadian landlords, but generally, like, could we see a extreme concentration? No, probably not. And to be fair, like you might not necessarily want that, because if you look at what happened in Germany, like they just did a referendum to actually like take all of those. I think it was Germany, right? Where they actually did a referendum to take all of those units away from private ownership and have them state owned, which is not necessarily a win for uh, the unalienable property rights as we hear about them in Canada, which is one of the big reasons why people, especially libertarian minded people, want to own property, right? Is property rights. Okay, let's jump to this next chart here. So, um, same kind of concept here from TD. Basically, mortgage service costs have settled. They're at a much higher level than they were before, but they aren't. We're not kind of off that volatility. You saw that huge spike up earlier, and now we're kind of away. We've gotten away from that scary volatility. You saw a little bit of a drop, but if I'm modeling my investment decisions, I'm modeling them based on, okay, I'm sort of in I'd be modeling sort of, can I survive a 4% rate environment for 10 years, right? And I think a lot of people are always ambitious to try and underwrite to the downside on the rate side of things, or upside on the price side of things. If your deal depends on rates decreasing or prices increasing, I think that, that's that a kind of thing where you do really might want to rethink that deal, right? Um, the the consequence of sort of this like indebtedness where we're at is this household debt per capita. Canada, our household indebtedness is converted to USD. Our household indebtedness is just significantly higher than a country like the US. And so we always wonder, like, why is Canada having such a hard time growing? A lot of people like to blame the government. And look, I'm among those people. I love blaming the government for stuff. But the reality is, like, we also have individual accountability that we need to own. And the reality is that Canada is the most indebted economy in the world for on an individual basis, and on a well, actually, at a national level, our government is actually kind of, I don't know, upper middle, let's call it, but we're not the worst. And from the US is the worst, but that's government debt to GDP. Individuals debt to disposable income, household debt, far worse. And you would say, oh well, maybe income is not the right way to look at this. Should we look at liabilities to net worth, maybe, as an example, because Canadians have a higher net worth than Americans because we owned this real estate and because our real estate values went up? The answer is still no. We're still worse. We still have a higher liability relative to our net worth than Americans. All of this to say that the Canadian economy, I've said this a couple of times on these calls, but like, people ask me, like, what's the catalyst for economic growth in Canada? And the reality is, it comes from us as the consumers. Like, the government can do stuff, they can make policy better, they can encourage more business, they can spend more money on research and development, they can spend more money on infrastructure, they can reduce taxes. There's so many different levers that they can pull. But those are uncontrollable factors. The controllable factor is how much debt we have. And so Canadian uh debt, or household indebtedness, Canadians are deleveraging, right? So we are reducing our debt exposure as it stands right now. Um, and this is going to continue, and it has to. And the reason is because, unfortunately, Canada built an economy around credit. And so a lot of other places in the world, people don't buy things if they don't have the money. We're not like that. We buy stuff that we don't have the money to buy, and we assume that we're going to spend the rest of our life paying for it. And this is how just our version of capitalism works, where we think that we're going to be able to pay it back. Our ability to pay it back in the future, it will be better. And so we're happy to absorb that interest burden between now and the future, um, because we want the things now. We want the nice house. We want the lease BMW. We want all the whatever, right? Like, we suck at deferring gratification as a society in Canada, and um, that is something we need to get away from if we want to grow. Canadians individually need to be able to spend more money if our economy is going to grow, and you cannot do that if we have too much debt, because now we're at a point where we're in a new credit cycle at new interest rates. Yeah, we could pile on more debt during COVID when I mean, you can see on this chart our debt level drop because everybody was getting helicopter money, stimmy checks. They didn't have to pay their mortgages, blah, 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 right? There was all these reasons. So our household indebtedness actually dropped. And what happened? The economy ripped because we could spend again, right? Because our debt level was lower. Also, interest rates were lower, and that made it easier to take on more debt, to spend more money, to grow the economy. We don't have that luxury anymore. So the only way for us to actually have more money to spend in the economy, to grow the economy, is to reduce our debt. How do we do that? We're seeing it right now in the real estate market. People are selling properties, right? Where's the biggest concentration of household debt in Canada? Mortgages. Okay, so people are selling properties, right? People are getting rid of frivolous expenses. They're paying off their credit cards. They're selling stocks to pay off whatever. That's what deleveraging looks like. The Canadian economy needs to deleverage to grow. Deleveraging is not a pretty process. Okay, that would be a recessionary activity. That would be a deflationary activity. So just keep that in mind. It has to get worse before it gets better. There's no way that, like, even if the Bank of Canada dropped interest rates to 25 basis points again, we would still only be able to go to that ceiling that we saw, right? And we're not that far off that ceiling.
Got a question here. Debt to disposable income. How is that defined?
So debt is total household debt, how much money you owe, all things combined. Disposable income is money left after taxes and basic necessities. So you just take the debt and divide it by the disposable income. So we have the highest debt to disposable income in the world. And yeah, go ahead.
Just wondering, what does the disposable part mean?
Money that you can spend, like money that you still have left to spend, right? Disposable just means it's like you can spend it, right? Yeah. Um, okay. Gonna jump over to house prices now. I'm definitely behind, so I'll try and rip through these pretty quickly. House price momentum, not trending in a positive direction. I mentioned a long time ago that after the big drop, if you look at the 1990s, market traded sideways for a long period of time. I would expect that to continue. Even when we get to recovery, it will be a very slow recovery. Um, the uh, so somebody mentioned there's also positive debt like a mortgage since you can reclaim your investment and it adds to your ROI. Yes and no. I mean, you could also it's a double-edged sword, right? You could also argue that leverage cuts great on the way, to improve your ROI on the way up, but if somebody's house is going down in value or the cash flow negative, then their losses are also amplified, right? By the leverage position. So if you have very little cash in, but if you only put 10K into the property, let's say you're 95 LTV, first time home buyer, and your property goes down 10K in value, you just lost 100% of your investment. If it goes up 10% in value, you just made 100% of your investment, right? So, or sorry, if it goes up 10K in value, uh, you know, so it amplifies returns to the positive and the negative. So I agree with what you're saying, but I would also say that it's worth noting that the same is true to the downside. Um, and I think a lot of people dismiss that reality that debt cuts both ways. Um, I'll jump over house price history because it's kind of just a reiteration of what I just mentioned, but basically sideways market. Resale inventory, not necessarily piling up like we're hearing. This is at a national level, so it is in some markets, and I'll go through which markets are in buyers versus sellers territory. But we're still really not even back into a historically balanced market territory where you've got sort of like your inventory in the 4 to 6 months of supply range. And so I would say, a lot of other markets outside of the Lower Mainland and Toronto or the GTA are kind of like Southern Ontario is kind of skewing this in a positive direction. Ontario and BC are skewing in a negative direction. And so at a national level, we look relatively balanced. Sales to new listings ratio, again, still sort of in that balanced to buyers market territory. Balanced market territory. So we're kind of like dead in the middle. This is a good market, by the way. This is what you want to see. You want to see a market where um, the market is balanced. People can take time to transact. They can get conditional offers in. They can do home inspections. They can ask their lender to appraise and finance the property properly and all of this stuff. This is a good outcome. As real estate professionals, we want this to be taking place, right? This is a good market for us to do a good job, to represent our clients well. Okay, the next thing I'm going to look at here is market balance by region. So really the only markets where we're seeing buyer's market territory is your Ontario and not even all of Ontario, like basically Toronto, Barrie, and then your Lower Mainland, so basically Vancouver area. Um, the rest of Ontario is sort of more balanced, or sorry, the rest of Ontario and BC is kind of more balanced, a little bit more favorable to buyers in most markets, but Victoria still favorable to sellers. Calgary slipped into balanced market territory, but still slightly in favor of sellers. I would say, like, if you want to kind of understand that, the balanced market territory is between the green and red line here. If you're to draw a line at 50%, so sort of in the middle of those two lines, anything above that 50% is slightly more favorable to sellers. Anything below it is slightly more favorable to buyers. This is your sales to new listings ratio. So basically, take the number of properties that sold last month and divide it by the number of properties that were listed last month. Whatever percentage you get, that's the metric. Everywhere outside of Ontario and BC, all in markets that favor sellers, and many of them in sellers markets. Why is this the case? The reason for this is because those are markets where people can afford to buy houses. And so people are still buying houses, right? It's really not rocket science. Like if people can afford to buy something and they want to buy that thing, they will buy the thing. And so in Ontario and BC, people still can't afford to buy houses. Why? Because prices are still way too inflated. And not to say that they're going to come down significantly more, but they either way, there's the way that we buy houses in Canada, we use mortgages. There's three levers in that equation that can change the way that somebody can afford a house. One is wages. So wages need to go up. Probably not super likely heading into recession with rising unemployment. We might see some wage growth, but it's not going to be outsized. Number two is interest rates need to come down. Do I think that that'll happen? Probably we'll see cheaper rates sometimes over the next 365 days. The last one is house prices. Could house prices come down? They might have to, right? If we need more affordable houses, like the cure for high prices is high prices, right? If high prices are too, or if prices are too high, people stop buying it. Prices have to come down. The market might take more time to adjust, but this is why we're not seeing tons of transactions in the Ontario markets because there isn't a huge group of people who can afford to buy houses at this price. Just see a comment on the in the chat there. Due to the new CMHC rules raising the insured mortgage cap to 1.5 mil, will the homes in the 1 to 1.5 mil range see the greatest appreciation? Probably not. You're the buyer who's using CMHC to buy a house. There's such a limited number of those people who could can qualify for anything higher than like that increase was more for like upsizers than it was for your kind of like first time buyers who are buying with that high loan to value mortgage. Yeah, some like it was basically just a policy for Vancouver and Toronto where first time home buyers are high earners, maybe $250,000 household income. That's what you need to qualify for 95% or whatever 87% mortgage over $1 million or whatever it is, right? So it's not so much just purely policy, it's also underwriting. So their income is the biggest prohibitive factor in people actually being able to use those mortgages. I actually presented this on one of these calls like 6 months ago, or it would have been maybe even longer. It was towards the end of last year. Basically, TD modeled out exactly what you're describing, Ryan, which is that would front load all of or like all of the any of the gains that would have happened as a result of that policy would happen almost instantly. They expected it to all happen like within the first quarter of last year, and yet prices fell in the first quarter of last year. And so why is this? And the reason is because other things are more powerful than having more debt, right? The job market was more powerful. Tariffs were more powerful. Trade war, all of these economic factors, the fact that we're in an election, all of those scary things overpowered the positive impact. Do I think that those will see the greatest appreciation? Probably not. I think that your price floor, like or your entry level product, is where you're going to see the strongest appreciation, just because relative to the remainder of the market, relative to every dollar that's added to people's wages, the buying power gets stretched the furthest because those are lower value. So any dollar that I have, if I amplify that as buying power, um, I can pay more for I can pay a higher or sorry, the magnitude of the increase of price that I can pay for a $600,000 property is much higher than it is for $1 million property. If a renter can afford to buy, would I recommend proceeding to buy or continuing to rent in the GTA? And if you recommend buying, what's the best to buy, condo, townhome, detached? I mean, there's really no one size fits all answer to this question. Like this is an exercise that somebody just has to run the numbers on their own, right? So the easiest way to think about this is um, what's my cost of renting? How much money can I save on top of that? So like let's just take two properties side by side and you can probably find this because there's so many properties on the market right now. So you go look at a condo. How much would it cost me to own this condo? Okay, I'm going to have to put $100,000 down. What return could I get on that? Reasonably, am I a good investor? Am I actually going to save that money, or am I going to go blow it on a Lambo? Right? If I save the money, what am I going to get 10% per year, or the S&P average, or what am I going to get put in dividend stocks and get 5%, whatever? Actually run the cost benefit analysis. Punch this into you can even type it into Chat GPT now. Give me a cost benefit analysis on renting this unit for $2,000 or owning this unit for $3,000 a month plus $100,000 down payment. For some people who are good at saving money and good at investing, it always makes way more sense for them to continue renting. The truth is, most Canadians are not that. most Canadians suck at saving money, as we saw on the debt to disposable income chart, right? We are the worst at saving money and the best at piling on debt in the world. And so if and I fall into this category, so I'm saying it with empathy, not with judgment. I want to buy a house because I have kids and my money just disappears. And so if I want to accumulate wealth and save money, a mortgage is a really good tool for me to do that. When I was single and I didn't have to spend a lot of money on like house, kids, blah blah blah, all this stuff, I could save a lot of money. I could invest it really well because I had the time and the freedom and the to try and put my money into that. It's just purely a cost benefit exercise. In a lot of cases, good investors can easily beat homeownership. Most people aren't good investors. Most people aren't good savers. That's why Canadians love homeownership. Okay, sorry. I'm gonna try and burn through all these real quick here. So, um, this one I think is important to think about. First time home buyers, basically first time home buyers basically get a 40% or sorry, 40,000 or $50,000 advantage. It's a government subsidy. It literally is tax subsidized. So they get HST removed if they buy a brand new house. And that kind of ends at homes priced over $1 million. And so I would say that we're going to see a lot more builders trying to build houses under $1 million bucks. This could be condos, this could be, townhouses in 905, et cetera. And the reason is because they're going to try and capture this. Like builders probably can't necessarily charge that entire gap, but let's say builders get 20K of that gap. The buyers get a 20K discount. Let's call it. It's not, that's the wrong word, but it's like a subsidy, because they're not paying the GST. It's a win-win for everybody, I guess, except the government, but they don't need more money. So whatever. And so this is a trend that I think is really important for people to look at. And if you have first time home buyers, I would be strongly encouraging them to at least start the process of looking for opportunities in the new build space. The reason being, like, this is, we haven't had a setup like this since the 90s where you can negotiate with builders, maybe not on price per se, because they are negotiating on price, but they're doing it in a way that it doesn't really show up in the market. But you can get concessions on closing, you can get tons of upgrades, all of these things. If they've already decided that they want to enter the market, um, again, it's um, it's not up to me to tell somebody whether or not it's a good time to time the market per se. But if they've made a decision that they want to enter the market, there are a lot of good opportunities in the new construction market for first time home buyers, not for anybody else, but for first time home buyers in comparison to the resale market right now. And so this is something I would very much be encouraging people. If you know builders and you know first-time home buyers, if you can figure out a way to do deals between the two of them, I think this is one of the best opportunities in the country right now. Not to say that new homes are priced appropriately or anything like that, but if that's what people are looking for, I do think there's a good opportunity. I think the policy outcome of this will be very evident in a year's time. Where this is most concentrated is in Toronto and Vancouver, where in Toronto, it would reduce the mortgage payment for a first-time home buyer by up to about like almost $250. And it would reduce their down payment by almost $10,000. Vancouver, slightly less than that. And then you can see the remainder of the cities. But like even in a Calgary, your mortgage payment's going to go down by 150 bucks a month compared to what you would have paid. This is just from the HST, like literally just from the HST being rebated. I'll skip over this one. Okay, pivoting more into the rental side of things. I know I got 5 minutes here, but we're building a lot more rental than we are home ownership now. So your rental apartments is the light green line here. This is from Desjardins. They didn't really choose exceptionally clear lines, but I have a better chart actually from BMO here. This was in Better Dwelling recently, but basically your rental starts going up big and your condo starts going down big. This is like the clearest image illustration of how we're progressing towards a renter's economy. We're building way more rental than ownership housing right now. And this is a risk factor, by the way. Like if you're an investor, you should be modeling huge increases in the vacancy rate and decreases in rents moving forward, because you're going to be competing with tons of massive professional landlords over the next several years. This is more concentrated in certain markets than others. Now, So in Ontario, where you would think that it's going to be the worst, in Ontario, CMHC MLI Select doesn't actually get a ton of housing built in Ontario because the economics of it don't work exceptionally well here. So Ontario, we're not seeing a ton of purpose-built rental housing starts. We're seeing massive amounts of purpose-built rental housing starts in BC, where literally this is crazy. Like this is a crazy stat. Over 14% of, if you take 100 units in BC, if BC only had 100 units right now, or let's say 100,000, 14,000 units are under construction right now. So if BC's population doesn't grow and new household formation doesn't increase and people aren't leaving their parents' basements to go rent new units, BC's vacancy rate would go up by that exact amount. And obviously, that's an oversimplification. That's not going to happen. But um, these are huge upward risks to vacancy, right? Atlantic Canada, just as bad, right? 12% of their entire rental supply is under construction right now. Alberta, over 8%. These are things that you need to be underwriting if you're considering making real estate investments in these markets. These are all going to make rents fall, make vacancy rates rise. To look at this in your like in another way, the ratio of rental housing starts to condo starts is the highest that it's ever been and climbing at a very, very fast rate. What does this mean? Early on in the call, this is just prop TX board, so a lot of Ontario boards. Comes from the Habistat. If you're a member of the Toronto Real Estate Board, just go to the habistat.com. You have access to this. Um, the most leasing volume we've ever seen, even though the market is really bad, right? We're seeing more leases taking place than we've ever seen, and it's like way above the last couple of years, way above, right? So if we keep seeing more and more leasing, this means that we're heading towards this renters economy that I've been describing. A couple of cool charts here from a buddy of mine, Rob, who's at my brokerage. This is all GTA, but we're seeing resale months of inventory higher. We're kind of seem to have settled into this channel of above 5 months. Would sort of be comparative to like your kind of historic normal balanced markets, right? Definitely a market that favors buyers. Um, Number of sales trending down, so we're not seeing an increase in sales in the GTA. The number of active listings seems to have settled into a higher channel. We hit a record high a couple of months ago, or a couple of weeks ago, I think. Rob does these on a weekly basis. I would encourage you to, if you follow him, or if you're on like any social media, look up Rob Merstiglio. He puts out really, really good stuff on the Toronto micro. Um, the active rental listings again seem to have kind of settled into this higher channel. You do see these sort of weekly fluctuations, but obviously significantly higher than the historic. Power of sale as a percentage of total. Power of sales, like they still are very high, but we're seeing so many other listings that as a percentage of total, they're actually shrinking. Um, I will skip this one because I've already mentioned it a couple of times. Active listings on PropTX boards again hit an all-time high recently. Number of active listings you can see here. That's the same chart as the one before. This is just overlaid year over year, but we're about like 10% higher than any other year. This is another great chart that really indicates how we're progressing from homeownership from a policy perspective, from homeownership more towards rental. CMHC now ensures a higher dollar volume of rentals than homeowner or like owner occupied units. So the two ways CMHC insures units, they insure through for homeowners through owner occupied. So if you go buy a house, you want to buy with less than 80%, or sorry, if you want to buy with less than 20% down, you have to get insurance to do that. CMHC is the one who provides the insurance. With rentals, they use something called MLI Select, as well as a couple other MLI Standard. They have a bunch of different insurance programs for investors to create housing. They've just crossed the threshold where they're now insuring a higher dollar volume of rentals than ownership. And so even from a policy perspective, it's visible that we're trending towards a renter's economy. I'm just gonna. How are we for time? We're over, eh? Let me see what else we have here that I really want to cover. Actually, the next chart. This is a good example of like what happened. So Calgary went through what I was mentioning, where they saw an oversupply or an over construction. Um, where so in Calgary, you're brand new. So just look at the bars on the right hand side of the screen here. Your brand new houses, so anything built after 2015, your brand new apartments, sorry, they were trending at a 2% vacancy in 2023, which is the blue bar, like the kind of pure blue bar in the middle here. And then in 2024, that vacancy rate jumped up to 7%, right? So again, cast that out over all of those other markets that I just mentioned are going to see. Let me see if I can go back because I think I have the chart here. Yeah. So all these other markets where you're seeing a ton of rental construction, cast that out and think about what could happen to the vacancy rate in all of those areas. What else do I have here? That's good. This is probably a decent indication of why we're seeing rent growth changing. Population growth is basically zeroed out. And so, do I think that we're going to see 0% population growth for the foreseeable future? Probably not. I would imagine it'll probably be above zero next year. But like a year ago, when I saw that I saw rents starting to fall. Like I guess it was not a year ago, but like 6, 7 months ago, I saw rents starting to fall. It would have been a year ago because I was consulting for a developer in Toronto, and I mentioned to them, I said, I'm willing to bet that population growth is falling. You just can't see it in the data yet because rents are falling, and you could see it, and they are super correlated, right? So you can always see, why are rents falling right now? Well, because population growth is falling at this point in time. Um, I think the rest of the stuff is really on tariffs, and I honestly do feel like I've kind of beat a dead horse on that one. So I don't really feel like I need to go through it, and maybe I'll just leave you with this chart that so far tariffs haven't added a ton to inflation. I mean, they've added a little bit, but not a ton. But the Bank of Canada is concerned that there are potential pass-throughs to consumer prices, and their upper bound would be pretty scary. And the biggest areas where there's risk is in food, which you can see on the right-hand side of this chart here. This is all on the Bank of Canada's website, by the way. If you just search tariff pass through Bank of Canada, and durable goods, you can see like the way the range is. So durable goods is like your stoves, fridges, stuff like that. You can see the range is not massive, so they almost fully expect these tariffs to basically completely pass through to consumers. So that's like, as real estate professionals, where we have buy and sell products, where we often interact with fridges, stoves, etc. This is an important thing for us to know. Anyway, I'll leave you with that. If anybody has any questions, I know we're over time here, so I'll try and blow through them quickly, but I'm happy to answer any questions.
Yep, we did have one question that came in about 10 minutes ago. Um, how does home ownership impact Canada's attractiveness to high-skilled talents?
Um, I don't think it does at all, to be honest. I think that like people who are really skilled or like marketable from a talent perspective, like they're going to places like New York, and New York has a very low home ownership rate, right? Everybody rents in those markets. I mean, people who are like that, like if we're talking like really high skilled folks, right? And look at Silicon Valley as well, because we export a lot of talent, like tons of Canadian grads from engineering and comp sci schools like Waterloo are going to Silicon Valley. Are they owning houses in Silicon Valley? No, it's like one of the most unaffordable housing markets in the world. Does it seem to matter to them? No, because they are incredibly high earners. They're very smart, and so they can go and invest. So when I go back to that answer that I had for the other guy who, apologize, I can't see your name in the chat here because I got a bunch of windows up, but about, should I buy or rent? If you can make a better return renting, then you should rent. If you can't, then you should buy. And that's really all life is about. Not life, like life's about a lot more stuff than that. Family, enjoying life, whatever. But wealth creation is about how quickly can I turn my time into assets. And people who are incredibly qualified, skilled, etc., are very good at turning their time into assets. And so they aren't necessarily concerned about owning a house per se, right? And so I don't think it really matters in the grand scheme of things for people. Yeah.
How does Canada rate with places like Mexico for investors buying property to rent or own?
Like from a homeownership rate perspective, I would say I think Mexico has a higher homeownership rate than Canada, slightly, or it's like pretty close. But how does it rate? I don't really, I guess it would depend on what the metric would be, but I think
Yeah, I
Canadian, yeah.
think they're referring to investors.
Um,
A
oh,
return, sorry, return on investment.
from an ROI perspective, you can get higher yield in markets like Mexico. Like you can buy at a greater rate of return in many markets all over the world, but there's a lot of factors that that are at play, and a lot more risk, right? So typically it's a risk return trade-off. Canadians like investing in Canadian real estate because they know the market, the risks are low, they can get access to leverage, and they're happy to accept a lower return for that. Or Canadians were historically happy to accept a lower return because they felt they were going to get capital appreciation. Um, and so your yield is higher. So like your return or ROI might be higher, but it comes with a higher risk. So it's risk return trade off, right? So risk weighted returns would probably be the same, to be honest.
Hey, and we just had a couple people wondering where they could access your presentation on their own afterwards.
So do we email it out? I don't know. I think we can email it out. I'm happy to just email a link out to everybody who's on the call. If you want to do that.
Yeah, I think we're working on that capability to be able to do that.
Yeah, if you want to just go to yeah, it'll be on I think Rem's YouTube and Valerie's YouTube. And what I'll do is we'll just put a link. I'll get it hosted on Google Drive, and I'll just put a link to it in the YouTube video because I think you guys posted on your YouTube and we posted on Valerie's YouTube as well. So yeah. Okay, cool. I think that's everything. I appreciate everybody. Thanks for your attention, and I'll see you all. I do that. We do this on a monthly basis. I think the last Tuesday of every month. So, um, I think make sure you subscribe to the notifications on REM's website, and you'll get a calendar invite for it. And we'll see you then. And if you have any questions or any data points you want me to cover, I'm always open to feedback and kind of things that you want to see. So yeah,
Hey,
cool. Okay, thanks everyone.
okay, see you guys next month.